one-time cost increase and then it'll just
Going? Let's find out. Joining me on the program is Jim Bianco from Bianco Research. Jim, let's begin with some of the inflation numbers came out. The core rate jumped. And then I think yesterday the PPI was one of the biggest increases we've seen in 3 or 4 years. So what's your take on inflation, number one? And number two, does this make it more difficult because the market was anticipating maybe there would be 3 rate cuts this year? If those numbers keep spiking, I don't know if that would happen. What's your take?
yes, to your second question, it's going to make it complicated and more difficult for the Fed to cut rates, but the market is largely expecting it. So, as far as CPI goes, the data did show a bit of a creep up in CPI. Now, I think the more important metric here is the core inflation rate, which takes out food and energy, not because food and energy aren't important. It's rather that what you've seen is that away from those, because they move up and down with weather and supply considerations that have nothing to do with the general level of inflation, you have core inflation now at the CPI level over 3%. And that is a problem for the Fed to cut rates. They've only cut rates, and when it's been at that level 2 times in the last 35 years. Last year, and that didn't end well because interest rates went up. Long-term interest rates went up when they were doing it. And in 1990 to 91, during the Gulf War, when everybody was panicking, we were going to have a depression because oil prices had doubled in a couple of weeks. So it's really rare to see the Fed want to cut rates with inflation this high. As far as PPI goes, that number was 9/10 on ex-food and energy again. That was the highest level we saw since the peak of inflation in 2022. That is a concern that at the producer price level, kind of the business level, that you're starting to see inflation filter through. Now, there was a bunch of one-time effects in the inflation numbers for PPI that probably won't last. But there is a third measure of inflation called the personal consumption expenditure, or PCE. That's the measure that the Fed likes to look at. The PCE measure uses the same inputs as CPI and PPI because some of the PPI categories are in the PCE measure. It just weights them differently. So Wall Street goes through this exercise where they look at all of the inputs to PCE. They look at CPI, PPI, reweight it, and that looks like it could actually comes out at the end of the month as a very strong number, like 0.6, 0.7, because of what happened with PPI. Now, that's a problem because the Fed says, this is our measure. Our measure has been elevated. We don't want to cut rates. And then when it finally gets to the point where they say, okay, we're going to cut rates, it looks like their measure is going to shoot up to like a year plus high at very uncomfortable levels. So a week from the day we're recording on August 22nd, Jay Powell goes to Jackson Hole and he gives his speech. And that's going to be a really interesting speech. If he's going to make the case that they should cut rates, he's got some explaining to do why he's going to do that in the face of 3% core inflation and that big PCE number that should be coming. Or if he wants to push back on not cutting rates, then, it'll be like the movie Trading Places, when they get the crop report, when he says, I'm not going to cut rates, everybody will ignore him and will turn to Trump's Truth Social account and wait for the incoming posts ripping Jay Powell a new one for not cutting rates in September as supposedly the market wants. So the inflation number has greatly complicated what the Fed wants to do in September, and that is supposedly cut rates.
And let's talk about, he also made a new appointment, and the new appointment is on the dovish side. So what influence will that have?
Yeah, so he did appoint Stephen Moran as the Fed governor. He is the current Council of Economic Advisors head right now, but that appointment is only to finish off the term. So let me back up. Andrea Krugler was a Fed governor. Her term ends in January. She stepped down as of August 8th. So Trump appointed Marin to take over the term from whenever he gets approved by the Congress to the end of January. So just 4 months. He's held open the idea that maybe he'll also appoint him for the term after that, which is they run 14 years after that, or maybe he'll appoint somebody else. But Stephen Marin has to get approved by the Senate. They are on recess until after Labor Day. It looks very unlikely that they will approve him before the September 17th FOMC meeting, so he won't be there to vote. Assuming they approve him before the October 30th meeting, he'll only get to vote in 3 meetings. And then whether or not Trump reappoints him or not remains to be seen. Now, why did Trump do that? Because he's holding that seat open for Powell's replacement. The Federal Reserve chairman also has to be a governor. So, in order to bring somebody in from the outside, he might need to appoint them to that seat in January to be a governor and then also appoint them to be the chairman. Now, if he picks somebody who's already a Fed governor, such as Chris Waller or Michelle Bowman, to be the chairman of the Fed, then Stephen Marin or somebody else could just carry on as a Fed governor in that seat. So nothing has been settled with that appointment other than Marin is going to be the Fed governor for a couple of months. And we still don't know who's going to be the Fed chairman. We still don't know who's going to be the Fed governor after January for that seat.
So I want to turn another attention that also may affect this. I think the Treasury is going to have to raise, I think the figure, you probably know it better than I do, it's like 1.6 trillion. Jim, nobody in Washington, in either party, is talking about the national debt. I'm looking at the debt clock right now. We're at what, 37 and a quarter trillion almost. Interest on the debt is 100 billion more than what we spend on defense. How long is this going to go on before we get a Liz Truss moment and the bond market revolts, kind of like what they did with Powell's rate cut last year?
You nailed it in the way you asked the question. Liz Truss was the prime minister of the UK. They kind of ignored their debt problem too till they got to the breaking point. And what you said there in the question is exactly right. Who stops this debt train? There isn't a bunch of Thomas Jeffersons waiting to get elected that are going to go to Washington and reform this. Doesn't matter if we're talking about the Republicans, if we're talking about the Democrats, if we're talking about the Libertarians, independents. Nobody wants to deal with this. So as long as the bond market allows the federal government to borrow at reasonable interest rates, it will continue. At some point, the bond market will put its foot down and say enough. More specifically, it'll say if you want to continue to borrow at a couple of $1 trillion a year, it's going to cost you punishingly high interest rates, which would then filter through to punishingly high mortgage rates, loans, and everything else. And it will also, affect all other financial assets as well too. I like to say that the bond market is the bond market is the destroyer of worlds. There will never be an instance where you can't issue treasury debt. You will always be able to do it. You just won't like the interest rate that they're going to charge you to do it. And if that interest rate is high enough, people that are in stocks or private investments, crypto might say, man, that's risk free. And look at those interest rates. Sell my stocks and let's go into that. And it sucks all the money out of everything else. So that's how you wind up addressing this problem. Now, when does it happen? That's the open question. Where is the breaking point on this? I don't know, and I can't speculate on it because that's code word for I've tried to pick dates in the past and they've come and gone, and it hasn't happened yet. But just like in the UK, it'll probably sneak up on us a lot faster than we think, and it will be a crisis. And the unfortunate thing about it is when it does sneak up on us, it'll be one of those situations where the bond market will go to punishing the high interest rates. The government will be told that they can't keep borrowing at this. You're going to have to make some choices. And then the politicians might correctly say, some of these programs are worthwhile. Some of these things we want to do. Okay, well, you should have fixed it when you had the chance because now you're going to have to cut in a chaotic way because the bond market is demanding you do it right now indiscriminately. And there is no discrimination in what you want. So that's the fix for how we're going to get there. I just don't know where it's going to wind up coming. But if I had to give you, if you want to pin me down, I'd say in the next 5 years, we'll probably see that event come with those punishingly high interest rates. I wish I could be more optimistic. I could be if you could tell me that we're going to get a bunch of people in Washington that will address this problem before that. But I just don't see where those people exist, let alone that we're going to vote them into office.
So let's move forward and let's just say that that event takes place. Jim, where are they going to cut? I'm looking at the debt clock. We're spending 1.7 trillion for Medicare, another 1.5 trillion for Social Security, almost 920 billion for defense, and over trillion 41 billion for interest. So do they cut defense? Do they cut Social Security? Do they cut Medicare? Because entitlements are what, about 65% of the government spending?
All of the above. What happens when you get into a situation like that is interest rates go up. Then you're told, well, to stop interest rates go up. They create financial stress. They create unaffordable homes because of sky high mortgages. And everybody screams at the government, you got to do something about this. And the answer is, you've got to cut spending. Well, how are we going to do this? Take every budget you just said, multiply it by zero point 0.9. That's a 10% cut. There you go. We just fixed the problem. And then politicians say, but we can't cut defense or we can't cut social spending. And interest rates go up. And they go, but yes, we can cut this, but we can't cut that. And the bond market will be effectively saying, I'll keep going to infinity until you decide that it's time to cut spending. So basically, the way it'll happen, that's what I mean by in a chaotic way, is that when you get into a crisis like that, they'll just say to politicians, here's how you fix this. Take last year's budget, multiply it by zero point 0.9 or 0.85 or 0.95, whatever happens to be the number that we need to hit. And there you go. Every single line item goes down by 5%. Because that's my point, is that it's not going to be months of hearings, discriminate between some spending versus other spending. It'll be a chaos in a crisis that it needs to be done immediately. And no one is going to be happy about it when we get to that point.
Well, I'm proud to say that as a taxpayer, my portion of the debt is 323,000.
If I write them a check for $323,000, will they leave me alone?
And eliminate your taxes? I don't know.
Yeah,
Okay.
exactly. There you go. I just paid up my part. Now don't bother me anymore.
I want to get back in the weeds. You have an interesting take. There was a big revision of the job numbers that I think it was like 8 or 900,000 jobs that were eliminated that didn't exist. And we know that they use estimates in their model, Jim, the birth death model, all these kind of things. What's your take on here? And especially when we're seeing I guess, some softness in the labor market.
Yeah, so the actual number was that they revised down the May and June payroll reports by 258,000 jobs. They went down to 14 and 19,000 jobs, respectively. In the July jobs report, which is yet to be revised, came in at 73,000 jobs. These were gigantic downward revisions, only the second largest in 43 years. The largest was April 2020 when we lost 20 million jobs in a month because of the COVID shutdown, which was a special circumstance. And this put the labor market into a shockingly weak position that has really rocketed to the forefront this idea that the Fed is going to cut rates in September as a response to elite weakness in the labor market. Now, two things about that. One, there are lots of measures of labor markets. There's not just the payroll report that the Bureau of Labor Statistics puts out, which, by the way, President Trump fired the head of the Bureau of Labor Statistics later that day because he was so upset with the report, claiming that it was partisan and rigged. But there's all kind of other measures, whether they're private sector measures, state unemployment insurance, surveys done by the National Federation of Independent Businesses or the Institute of Supply Management. And collectively, all of those measures of the labor market say that the labor market is okay. The jobs report is an outlier right now, and it's one report that's been an outlier. Now, what I've argued is these numbers, when you talk about the way that the Bureau of Labor Statistics measures the jobs numbers, it effectively becomes driven by the population growth of the country. There's 164 million jobs in the United States. There's 240 million people, I believe, that are in working age between 18 and 64. And so those numbers, when you talk about how many more jobs did we create, what's the unemployment rate, are largely driven by population growth. In the last several years, the fertility rate in the United States is the lowest it's ever been. And what population growth had been driven by was immigration, both legal and illegal immigration. So from 20 to 23, when we had massive immigration, we had huge population growth, and that did two things. It boosted up the number of jobs that they were recording in their surveys that they were doing every month, because there's more people in the country in the labor force looking for a job. And yet, because there was more people coming in and a lot of them were unemployed, the unemployment rate was going up. Now we have the inverse of that. Because we've shut the border, and President Trump earlier this month put on Truth Social that for the first time in 50 years, we have net negative immigration. Net negative immigration means more people leaving the country than entering. And he said it was the first time in 50 years, I might add, because we only have 50 years of data. It might be the first time in American history that we have net negative immigration. Now, some people quibble that that might not be the case, but they're all in agreement that if it's not the case, it's very close to zero right now. So what I'm arguing is we have no population growth in the country. And that got slammed shut in the last 90 to 120 days with the closing of the border, the arresting of undocumented workers, the rest of them hiding. In fact, Los Angeles has already been talking about that there's a significant drop in bus ridership in the city of Los Angeles because a lot of undocumented workers aren't going to work. They're hiding because they're afraid that ICE is going to arrest them. This is what I think is the driver of the slowdown in the labor market. Now, what's important about that is what I'm arguing is if you have no population growth, you're going to have no payroll growth, and you're not necessarily going to see a rise of unemployment. And we haven't. The unemployment rate is not going up because we're not having unemployed people coming in the country every month anymore. And if that's the case, what's being lost on everybody who says the Fed's got to cut rates, panicking about the labor market is, and I'll quote the American Enterprise Institute, who's done work on exactly this subject, that by next year, we might only need to create a positive jobs number. Anything above zero might be enough jobs for the United States. If you have no population growth, you don't need to create jobs every month. We are all used to in the financial markets that the average number is about 80 to 100,000 jobs. That's when you had population growth. And most of that was, almost all of that was immigration. And if there's no immigration, net negative immigration, we haven't gotten our head around this idea that anything above zero might be enough jobs by next year. And these 1973 that we saw 35,000 jobs over the last 3 months might be enough. But instead, Wall Street is looking at 35,000 jobs, panicking and screaming the Fed's got to cut rates. Now, the mistake here that I've worried about is if you're saying we have to stimulate the economy to create jobs when we have no population growth, either the Fed has got a magic tool that they can open the border and get more people into the country, which they can't, or all they're going to wind up doing is stimulating to get more jobs in the country. Well, let me give you another statistic. There's a statistic called the labor force participation. What percentage of people between 18 and 64 are in the labor force? It's about 62%. The other 38% are not. They're either students, military, housewives, early retirees, disability, some other reason that they don't have a job. So all you're going to do if you want to get back to 80 or 100,000 jobs without population growth is you have to raise the labor force participation. You have to turn to housewives, students, military, people with disability and saying, how much more do I have to pay you to go out into the workforce and take a job? That's wage inflation. So all you're going to do by cutting rates to stimulate the economy with no population growth is create inflation. You might wind up making the situation worse, not better.
I want to come back to inflation for a moment because Powell keeps talking about, well, we don't know the full effect of tariffs. There has been some suggestion with the uptick of these numbers that the tariffs are starting to bite. A friend of mine is buying a sailboat, Jim, that comes from Europe, and there's a 10% tariff on it. Plus, in California, California charges sales tax. You could buy a mega yacht, you're still going to pay sales tax on the whole thing. So if you take a look at the tariff and you take a look at the sales tax, it's almost 20% added to the cost of the merchandise. Now, he told me that the boat dealer is picking up half of it, and then the company that makes the boat will pick up the other half. But he's talking about all this money he's taking in, but somebody's paying that, and we're paying it when we buy stuff.
To that last point, this is kind of the crux of the argument. Prior to Liberation Day, which was April 2nd, the US was bringing in about $6 billion worth of tariffs a month. In July, they brought in about $30 billion. If you do the math, there's an extra 300 to 310 billion dollars of tariffs that is going to be coming into the country over the next year. Now, that means that stuff that we buy is 300 to 310 billion dollars more expensive. Who's paying that? You've got three choices. Choice one is the exporting country, like the Chinese or the Japanese, cut the price of the product that they're shipping to the United States. There's been some evidence that that's happened early on, right after Labor Day. The example everybody uses is the Japanese automakers that export cars to the United States cut their prices by about 10 or 12% in order to offset the tariffs. But it's only clear that they did that as a panic right after Liberation Day because they didn't understand what was happening. No one understood what was happening. And so they wanted to protect market share. Well, that ended around June or July, and they're starting to raise those prices again. The Chinese, there's really no evidence that the Chinese are cutting the prices of any of the products they're shipping to the United States or the Europeans or anybody else. In fact, the import price numbers came out. That's the prices of stuff that we import, and that's not really going down. So the countries that ship to us aren't cutting their prices to absorb that tariff. The second one is maybe the import companies are absorbing that price. Again, there's some evidence that they were doing that in the 30, 60-ish days after Liberation Day, that companies were squeezing their margins by paying some of the tariff for the final user. But even that is starting to reverse. And more you're hearing in company guidance and earnings reports and stuff that they're not going to do that anymore. So that leaves the third person that could pay it, and that's the consumer through higher prices. And I think that is starting to show up. Part of that, I think, started to show up when we were talking about with core inflation moving above 3% and maybe producer prices moving up. And the mistake I think people are making is they thought we would see the tariffs immediately on consumer prices right after Liberation Day. But the stuff that was on the shelves, to keep the example simple, was stuff that was imported before tariffs, before April 2nd. So all the stuff that we sold in stores in April and May and into June was stuff that was pre-tariffs. When you start getting into July, August, and moving forward, the stuff that we're going to start seeing on shelves now are stuff that had to pay tariffs. And I think there's some evidence that those tariff prices are coming and that those inflation numbers are going to keep moving up. Now, Wall Street will admit this. Yes, this might be happening, but they dismiss it as, oh, it's a one-time thing. It's going to be a step up higher in prices and then it'll all go away. President Trump, the day we're recording, left for his summit with Putin in Alaska. And before he left, he said, Next week he'll be putting more tariffs on steel and semiconductors. The step function argument that, oh, it's a one-time cost increase and then it'll dissipate over time assumes we're done with tariffs. I don't think we're ever going to be done with tariffs. As long as the stock market stays up and as long as the president can continue to raise tariffs, he's going to do it because he said his ultimate goal is to create an external revenue service and get rid of the internal revenue service. He'd like to do away with income taxes and have tariffs pay for everything that income taxes pay for now. So I think you're going to start to see those tariff prices rise, show up in the store, show up as a measure of higher costs, higher inflation in the coming months. And it didn't show up in April, May because it was being partially absorbed by the importers, by the exporting companies, and the stuff that was on the shelves didn't have the tariffs in them. The importers and the exporting companies have stopped doing that. And now the stuff that's coming up on the shelves are tariffed stuff. And so I think, from here forward through the next year or so, you're going to see higher levels of inflation.
Well, let's talk about something else that could be raising that. He wants to bring back manufacturing. The U.S. is reindustrializing, and we know that bringing a factory here, it's more expensive than, let's say, China or India or some other place. So you've got that. You've got the debt issue that we're dealing with. We've got the tariff issue that we're dealing with. And Jim, what happens if we have a bond auction, it goes bad, and the Fed has to come in and step in to prop up the Treasury market?
Well, on the last part, as I said before, the way a bond auction would go bad is not that, you would issue $10 billion worth of bonds and only sell nine. You would issue $10 billion of bonds and you'd sell 10, but the interest rate would be way higher than anybody thought it would be. That would be definitely the sign that we've hit that breaking point that we talked about. But you're right. I think the real issue when it comes to manufacturing is if you want to build a manufacturing facility in the United States from scratch and hire people to man it, that's a 10 to 20 year project. It's going to take you 5 years to build it, and then it's probably going to run for at least 15 years, if not much, much longer, before you have to renovate it. If you're going to make that commitment now to buy that land, raise the money to build that project, are you sure that these are the policies that Washington's going to have for the next 10 years? How about for the next 10 days? So I think there's a lot of people that want to do it, that see the potential, but then they're like, yeah, but what happens if I'm 6 months or a year into building my new manufacturing facility and they pull the rug out from underneath me and get rid of the tariffs? Or I've opened my manufacturing facility in 2029 after I've spent hundreds of millions of dollars to make it and employed a bunch of people to work in it. And then a Democrat comes into office and says, we're done with tariffs. And then all of a sudden I'm uncompetitive. So this is the problem that we face with this. It's a good idea in theory if you could tell me that there's some kind of permanence to these policies so that you could make those long-tailed commitments. Now, President Trump will come back to us and say, but the Japanese promised 600 billion and Apple promised, 100 billion and, trillions of dollars of investment. Well, some of that will be done. I mean, it's not going to be zero, but not all of that will be done. I mean, famously in Trump 1, in 2017, he went to Kenosha, Wisconsin, Racine, Wisconsin, and Foxconn was going to invest huge to build this gigantic facility in southeast Wisconsin. Speaker of the House, Paul Ryan, was there. President Trump was there, for the big announcement. The state of Wisconsin actually widened a highway because they were expecting tens of thousands of people to work there. If you go there today, because I don't live too far from there in Chicago, it's still an empty field. Nothing ever came of it, of any significance. There's a very, very small facility, employs a few hundred people, but that's it. And this is the problem with all of these commitments that we're hearing about people spending money. They're not written in law. You're just saying that you're going to do it. It doesn't mean you have to do it. And that's the concern that we have when it comes to this, when it comes to, investing in the U.S. for manufacturing everything else, is the policies, I think, is what's holding us back, and the permanence of them.
It reminds me when I hear all this investment coming, it's kind of like stock buybacks. A company will announce a stock buyback. In this case, they're going to announce an investment, but they're not obligated to do it. And since I've been in the business, Jim, every single American president has changed the tax laws in one way or another. Probably the only one that didn't was Biden, basically, but they were counting on, let's say, winning the election and Trump's tax cuts would expire. So, as a businessman, as you're talking about, if you're going to make a investment of $1 billion to build a giant plant somewhere, what certainty do you have that number one, they change the laws, or as you mentioned, that they get rid of tariffs? It creates a lot of uncertainty. And would you be willing to spend $1 billion on something where you're not necessarily assured of the outcome?
The only certainty you have is that they're going to change things. That's the problem with it. And therein lies the issue. They'll give you assurances on rebates and certain tax rates and everything else, but those can be undone, and often they are undone. And then, you're left with, $1 billion investment that all of a sudden now is not profitable anymore. And this is what I think is really holding everybody back. And that's why, like I was saying, I think when Apple says that they want to spend $200 billion in the United States on investment, I'll believe Tim Cook that he really wants to do it, but he doesn't know whether or not that when he's done doing it, if that's, or while he's in the process of doing that, they're going to change the rules and they're going to make some of that stuff unprofitable on him. And that's the problem with, I think, with everybody else, which is why all of these numbers wind up being far less than what everybody initially announces them to be.
I guess the other question is, what's the alternative? Because one of the things we found out with COVID, I had clients that couldn't get blood pressure medication because it comes from China. Rare earth, they have almost a monopoly on that. So what's the alternative?
Well, the alternative is to, prioritize business. Let me take the second part. Rare earths are not very rare. One of the biggest deposits of rare earths is in the state of California. It's on the Nevada border down there. It's environmental rules and it's a lot of other progressive rules that prevent us from wanting to do that. And so therefore we don't do it. But the Chinese are more than willing to do it, which is why we get our rare earths from them. As far as, when you're talking about blood pressure medicine and a lot of strategic businesses and strategic products, that they would be very good to have those strategic products made here. Another good one is shipbuilding. It's enormously expensive for the Navy to build an aircraft carrier. And part of the reason is, other than aircraft carriers tend to be expensive, but part of the reason is we don't have a commercial shipping business. Normally, if you go to China where they build their Chinese aircraft carriers, in the dry dock right next to the aircraft carrier is probably a big cruise ship being built. And so if you had that in the United States, Newport News, Virginia, or something like that, where we build a lot of the ships, where they're building an aircraft carrier and right next to it, the same company could be using the same people and the same materials to crank out cruise ships, it lowers the cost of everything. But we've made it so uneconomic to build ships in the United States that they're just not built here anymore. And so if we made a commitment to making these businesses more profitable by getting rid of some of the regulations and some of the taxes on them and allowing them to do it, it would bring down the costs. It would employ more people. But it's good in theory, but at the end of the day, then we all start worrying about climate change. We start worrying about the environment. We start worrying about worker rights. And I'm not saying we want to do away with worker rights, but are we having too much in the case of regulations? And then it never really comes to pass. And then all these businesses wind up going somewhere else, and we wind up exporting all or importing all that stuff, and then we wind up losing a lot of those jobs in the United States.
Yeah, it's amazing. I live in San Diego where it's home base to four carrier battle groups, and we have a shipyard because they're always working on the Navy ships. And I can remember in the decade and in the 90s where we were actually building ships here. We were building long distance freighters. I haven't seen that, Jim, in over a decade.
Yeah, I mean They're being built in other countries right now. And that's why it's so expensive, because now the Navy has to contract that shipyard to build one ship. And they have to bring in hundreds of workers and all of the infrastructure to build one ship. They can't turn around, like I said, and let's do some cruise ships and let's do some container ships while we've got all this stuff here because it's just not economic for us to do it.
I want to turn our attention now to the stock market, and I'm just absolutely amazed at some of the valuations. I was looking at Palantir. Here's a company that has a little less than 4 billion in sales and has a market cap of 430 billion, PE ratio trailing over 600 and almost 300 towards forward. And if you go to Nvidia, same thing, selling at 58 times sales. How much higher is this going to go? I mean, this is almost, to me, bubble-like territory reminiscent of the internet bubble.
So Palantir is a good example that you used because Wall Street's favorite metric is the forward PE ratio, what they think the company will earn in the next year divided by the current stock price. And it is currently on that metric, the highest valued stock in the S&P 500. And the amazing thing about Palantir is asks anybody what they do, and 99% of the people don't know what they do. I even wonder if some of the management of Palantir actually knows what they do. But they're in big data and they do a lot of stuff in the big data area. But the stock market is, by all metrics, very fully valued, if not overvalued. Now, two things about that. First of all, on valuation, that doesn't mean it's going to crash. That doesn't mean it's going to go down. Valuation is not a timing tool. Oh my God, the stock market's overvalued. Palantir's overvalued. Therefore, be careful, it's going to plunge. Not necessarily true. What it more likely means is that when you buy highly valued stocks over the next 5 to 10 years, you're going to wind up seeing very poor returns. Maybe somewhere around 0 to 5% will be the returns in the stock market. Historically, when you get to these levels, basically what the bond market is offering you as an investment right now. So that's the way you want to look at it. It's more of an expectations tool than it is a valuations tool. That the higher the valuation goes, the lower your expectation is that what these stocks will return over the next several years, several being the key word there. Maybe this year, maybe next year are still 2 good years. But, when you buy stocks like that, they have to deliver huge on earnings to meet those valuations. Now, the second question embedded in there, or the second thing embedded in the question is, well, who's buying these things at these levels? And there's been a marked shift in the investors in the market. Retail investors are now dominating this market to a degree that we haven't seen in many, many years. And not only are retail investors dominating the market, they're winning. And what I mean by winning is what was very clear during the break in the market in April, following Liberation Day, was the professional investor, the institutional manager, the mutual fund manager, the hedge fund manager. They sold stocks into that decline in April. And the retail investor was aggressively buying stocks, setting daily and weekly records as they were buying stocks into that decline. Here we are, 30% higher at all-time highs in mid-August. Retail investor played it right. The professional investor played it wrong. There's almost a mentality among retail investors that they hope a data point will come out bad so the market sells off because they want to buy dips. That's all they want to do. They want to see, like we saw with the payroll report 2 weeks ago, it was shockingly weak. The stock market was down 2%. There was gigantic retail buying that day and the following Monday. We're back at all-time highs. So that's who seems to be buying the market, is the retail investor. And that's different. So whenever Barron's likes to do their smart money poll, I always joke that, well, the smart money is, go on Reddit and ask all the people with $10,000 what they're speculating on, because that seems to be who's driving this market right now.
Yeah, that was interesting because the Wall Street Journal ran an article earlier in the week talking about this very thing. how retail investors are coming to dominate what's going on in the stock market. I want to turn our attention to bonds. You oversee or manage an ETF in the bond market. Jim, what are you doing when it comes to bonds right now?
Technically we manage an index called the Bianco Research Total Return Index, in which we discretionarily set the parameters of the index, how long or short its duration is, what its weightings are in mortgage and corporates, whether or not it's high yield or some other out of index bets. And there's an ETF by our partners at Wisdom Tree, WTBN is its ticker, Wisdom Tree Bianco Fund is its name. WTBN that tracks us. Think of us as like being the head of the S&P Index Committee, and WTBN is like SPY. It just tracks our index. So what are we doing with our index? First of all, let me say one quick thing about the bond market. We're back, at around 4.5 to 5% yields, whether you're talking about 10-year or 30 years. So there is a yield in the bond market right now. And because there is a yield in the bond market, interestingly, a broad index like the Bloomberg Aggregate Index or something like that of bonds has returned over the last year. So going back to August of last year, 6%. So the bond market is churning out 5-ish% returns. Now, that 6% might have been a little bit above average. So the first thing I want to point out about bonds is the status of bonds is they should churn you out about a 5% return. We happen to be a little bit short on our index, meaning that we're less sensitive to interest rates because I'm fearing interest rates are going to go higher. But with that coupon, even though interest rates go higher, prices go down, you could wind up still having a decent total return. Witness like I said, the 6% over the last year, even though rates have kind of gone up over that period. Additionally, we are underweight on corporate bonds and we're overweight on mortgage bonds. Why? Well, in the investment grade world, if you're looking to get a bigger yield, you could either buy credit, which would be a corporate bond, or you could buy a mortgage bond, which owns a bunch of other mortgages. I think the risk return profile in the mortgage industry or mortgages is better than in corporate bonds. Corporate bonds are much like the stock market, very overvalued, and I'm a little bit worried about them. We're also, have positions in short-term inflation protected securities, otherwise known as TIPS, because I think inflation is going to move up. They should benefit from those as well too. And we've got an outside the index bet on local currency emerging market bonds. It's probably been our best bet for the year because local currency emerging market bonds is basically a bet on the dollar weakening because we're owning another currency that would be strengthening against the dollar. You always want to own the currency that's strengthening, and that has worked out very well too. So the bond market in general, as we were talking about before, if the stock market's reaching these very high valuations, and over the next several years, you might be looking at a 5-6% return in the overall market, less in some of the more overvalued stocks. The bond market can offer you the majority of what the stock market should be giving you over the next several years with a lot less risk. Now that there's a yield in the bond market, a bad year, 2023 was a bad year. Now, I understand 20 to 22 was a disaster in the bond market, one of the worst periods ever. But we had to get interest rates off of zero to like 4 or 5%. That was a disaster. But now that we've got them at 4.5 or 5%, 10-year, 30-year, a bad year might be +1 or +2. A good year might be +8. I'm talking about 1 or 2% return in the bond market in a bad year, 8 or 9% in a good year, averaging about 5. It's now a competitive investment. Remember the old line, Tina, there is no alternative? There is an alternative now. It's actually the bond market. And actually, if you want to go short, money market funds actually might wind up working too. Well, the Fed's going to cut rates and they're going to come down. But for the moment, they're yielding around 4%. That'll give you about 2/3 of the stock market's gain with very little risk right now over the next several years. Now, if you want to make the case to me that the AI boom is going to continue and that stocks have got momentum behind them and they're going to keep going for the next several months, okay, I could buy into that argument. But they're not going to keep doing this at these valuations for the next several years, unless you want to make them a case to me that earnings are absolutely going to come flying in the door of all of these companies to justify these valuations. Usually that does not happen.
Yeah, I don't see it either. Well, listen, Jim, I know you have to get on to a baseball game here. So, in conclusion, it's likely we might get one rate cut in September, whether that continues afterwards. I think a lot, I hate to say this, data dependent, what happens to the inflation numbers, because if they start rising as they're doing now and likely to do in the future, it's going to make it very difficult for the Fed's credibility to keep lowering interest rates with rising inflation.
Yeah, and I'll say one other thing about the inflation numbers. 2% is the Fed's target, 3% is where we're at. If you're not steeped in finance, 2, 3, 3, 2, what's the difference? It's kind of like a low number, isn't it? Actually turns out to be a big difference. I'll give you one statistic. The employment site Indeed did a study, and they found that something like 35% to 40% of the American workforce currently has a job, and they're not getting a 3% raise. They're getting something less than 3. Core inflation is going up 3. Those tend to be the people at the lower end of income. It's not very rich people that are not getting a raise of 3%. It's usually at the lower end of income. That means that when they go to the store, prices are going up faster than their paycheck. They have to buy less things. Now, it used to be 60 or 70% of the workforce 2 or 3 years ago when we were pushing much higher inflation. It's down to 30 to 30, 35%. So it's better relative. It's still a third of the American workforce. So if the Fed has a target of 2%, and they're effectively by cutting rates in September saying, well, we say we have a target of 2%, but we don't really have a target of 2% because we're cutting rates when we're at 3. They're telling that bottom third of the population that isn't keeping up, sorry, you better go ask your boss for a raise, and otherwise you might have to just do with less. It's not a good situation to be in. And that's why inflation matters. That's why trying to get the inflation rate down even further is a must for the Federal Reserve and for government policy. Yes, it was 9% at its peak in June of 22. It's down to 3 now. That's good. That's excellent. But that's not enough. It needs to come down further. And that's going to be a big problem for the Fed if they want to cut rates and inflation doesn't come down. There's a lot of people that are going to be on the losing end of that equation.
I'm just thinking of what happens next year. It's a congressional election year, and inflation is a bread and butter issue. So if your average guy is seeing his groceries go up, medical expenses go up into the election, that's not going to be good.
Look at last year. The Democrats correctly said inflation's not a problem. It was 9 and now it's 3. And they said it's our policies that caused it to go from 9 to 3. And let's accept that for this argument. It was their policies. What the American public basically announced was 3's still a problem. And that's where I think, and President Trump says this all the time too. Look, we've fixed the inflation problem. No, 3 is still a problem when it comes to inflation. Yeah, it's not 9. It's not 5. I get that. But it's still too high. And that's really what people said last year in the election. And if we have inflation still above 3, it'll probably show up in the midterm elections as well, too.
Oh. Well, listen, my friend, I appreciate you coming on the program. I'm going to let you go so you can get to your baseball game. Who do you think's going to win?
Well, my Cubs have been struggling since the All-Star break, and I want them to make the playoffs, so they better win. Otherwise, I'm going to start hitting the red panic button.
Oh, okay. Well, listen, Jim, as always, have a great rest of the summer.